We've learned all about the perpetual system, and that is our focus. But now we're going to shift and just talk a little bit about the periodic inventory system. So as a quick reminder, the two systems, perpetual, which was our focus, we kept this running record of all the inventory. So we looked at those entries. Every time we bought something, it went into inventory. If we returned something, we adjusted inventory. If we got a purchase discount, we adjusted inventory. And then when we sold those items, we moved them out of inventory into cost of goods sold. So we were always updating under the perpetual. We always had the correct value in inventory. Periodic, which we'll look at now, it does not keep a running record. So this is where we don't know what our inventory balance is. We have to do a count at the end of the year in order to update inventory. So perpetual, always up to date. Periodic, the inventory is only up to date at the end of the year. Now, to be clear on this, it's not that someone using a periodic system doesn't record the transactions. They do record every purchase and sale as they occur. They're just not using the inventory account. So the periodic system, it's used by business that would sell relatively inexpensive goods, and therefore they're selling a lot of them. And they don't have a point of sale system. So they don't have a system where whenever they sell it, they can scan a barcode and it automatically updates their inventory. And because they don't have that system, it's just too time consuming and it would cost too much to track selling all of these small, inexpensive goods, because it would be someone's full-time job just to know how many of these items were being sold. So therefore, the way that they track this, every time that inventory is purchased or there's related costs, or if they have some type of discount or return, these things are all expensed. So they're all recorded. It's not like we can't, or we just don't record them. We need to record them, but they all go through expense accounts when they take place. So inventory does not get adjusted. And these are the accounts that you would see under the periodic inventory system. So separate expense accounts when these things happen. So when they record a purchase, you actually use what's called the purchases account. So that would be the account name. If you received a discount from paying early, it would go into what's called a purchase discount account. And this is a contra account because we know it decreases the amount that we're paying. If you had any returns or allowances, these are tracked in their own account, and freight in would also be tracked in its separate account. So we know from our discussions on the perpetual system that anytime we had these same type of transactions in the perpetual system, they ran through inventory. So we were continually updating inventory. Whereas now, under the periodic, they each actually go into their own account, and these accounts are considered expense accounts. So that's important. We will not actually be going through and doing journal entries for periodic, so it's good to have an idea of these, and you'll see these account names, but you're not responsible to actually do a journal entry under the periodic system. Okay, so this type of system, they're all recorded in these separate counts. And then as it says here, at the end of the year, or at least once a year, it may be done more often, but an inventory count would be done. And at that time, you actually know your ending inventory amount. And therefore, you adjust this inventory balance to actual, which also will adjust your cost of goods sold. Okay, so again, we're not going through the journal entries. You can skip that portion of the textbook. But what you are responsible for is knowing how to compute the cost of goods sold under the periodic system. So you do need to know this. So everything is expensed in the year as we saw in those accounts. And then at the end of the year, let's say, it could happen more often, but we'll just say at the end of the year, the inventory is counted. So we know that ending inventory balance. Now we can use all of that information to calculate the cost of goods sold. Okay, so this is how we will see it. And I'm going to start with a bit more of a simplified version, and then I will show you the full version. So we start out the year and we know the opening inventory amount. So let's say we're looking at a business that has a December 31st year end. They would count their inventory at the end of the year. So they counted inventory on December 31st, 2019. That ending inventory balance for 2019 equals the opening inventory for 2020. So we know the opening inventory based on the count that we did. So we have this opening amount, and then throughout the year, we purchase items. So we're purchasing inventory through the year. So to this, oops, sorry, hit the wrong button there. We're going to add our net purchases. And this is the portion, we'll just say net purchases for right now, but in the next slide we'll see that this is broken out into more detail as well. But just to keep it simple to start, we add in our net purchases. So how much did we purchase during the year? We also know that when we pay freight in, so getting that item to us ready to be available to sell, that's part of the cost of inventory. So we also add freight in. So now we've started with whatever we had the year starting with, our opening inventory, and we've added all of the amounts that we paid to get new inventory. So our net purchases plus our freight in. This gives us what's called the cost of goods available for sale. So just thinking about this in non-accounting terms, here's what you had, here's what you bought during the year. That's everything that you had available for you to sell. So from there, this is everything we could have sold during the year. The next thing that we know is what our ending inventory is, because we do a count of that at the end of the year. So your cost of goods available for sale can really be broken into two parts. It's either you sold it, so it's in cost of goods sold, or you didn't sell it, so it's sitting in your ending inventory. So we know ending inventory, and we're trying to calculate cost of goods sold. So we subtract our ending inventory amount, and that gets us to our cost of goods sold. So it makes sense if you really just step back and think of this. And this is not reality, but I think it's a good way to think of how you could do this. Let's say that a company purchases everything that they think they're going to sell in the year right at the start. So start of January, they have their opening inventory that they counted. They have this kind of estimate. They decide how much they think they're going to buy or be able to sell in the year. So they do all of these purchases up front. Again, this is not reality, but just thinking about it to kind of understand this. So whatever they started the year with, then they have all of these purchases that arrive. So these are the goods that are available for them to sell. They go through the whole year. They do all of the selling that they can. At the end of the year, they are either left with some amount of inventory or they sold it. So this cost of goods available for sale is broken out into either what they've sold or what they have left. So we're able to count their ending inventory to know what's left, and therefore we can figure out the total amount that was sold. So obviously it doesn't happen like that in real life. They're buying throughout the year, selling throughout the year, but you're still able to use the same formula to calculate your cost of goods sold. Okay, so I said net purchases here. That is if you're just given net purchases in the question. But we know that net purchases is really our purchase minus these purchase discounts and purchase returns and allowances, those contra accounts. So a more detailed look is seen here. So you still start with your beginning inventory, but now instead of just saying net purchases, we're calculating our net purchases. So here was our purchase amount, and then we subtract the purchase discounts, purchase returns, and allowances, and that gets us to this net purchase. So now we're actually doing the calculation because we're given more detail. So if a question just says net purchases were $405,600, you would do it this way, this kind of quicker step way. But if the question actually breaks out and tells you what the purchases and returns and allowances were, you would want to do this more detailed method. Once you get net purchases, this bottom part looks the same. Okay, so let's look at an example. The beginning inventory for this business is $20,000. Net purchases total $45,000, and freight in is $4,000. If the ending inventory is counted and amounts to $29,000, what is our cost of goods sold? So we need to go through and use that formula. So we start with our opening inventory or beginning inventory, whichever you say is easier. To be honest with you, opening is easier to spell, so I always say opening inventory. So that is $20,000. We need to add our net purchases. So here we're given the net amount, so we can just say net purchases were $45,000. And we also needed to pay freight in, which was $4,000. Now again, just a reminder, freight in is a part of cost of goods sold. If a question also gave you freight out and told you to calculate cost of goods sold, it would not be included in the calculation because freight out is an operating expense that would come later. It's not part of the cost of inventory. Okay, so we add these up, and this gets us to our cost of goods available for sale. So this is how much we had that we could sell in the year. We add it up and it's $69,000. So we have this available. We've either sold it or we have it in ending inventory. So we know that our ending inventory, so we can subtract that. So we say less ending inventory, which was $29,000. Once we get that, we're calculating the cost of goods sold, which is $40,000. So that is our cost of goods sold. So just pulling the information. Again, these numbers in each of these accounts would be, well, really just freight in. Well, I'm going to wait. I'll talk about this on the next slide, actually. So that's the easy method where we were told net purchases. But we can look at the same question, but now we're given this info a little bit different. So we still have beginning of $20,000, but now we've broken out how they got this net inventory. So we had net purchases. We had purchases of $50,000 and there were $5,000 of returns. So now, as you can see here, I've broken out this calculation. So I need to show the purchases, show the purchase returns and allowances, and calculate this net purchase amount. From there, the same freight, same ending inventory. So the rest of this is the same, and we still get to the same cost of goods sold. It's just showing a more detailed method to get there. So if you, as I said, get a question that tells you what the purchases are, here's what the returns were or allowances as well as discounts, you need to show it broken out in this manner. So as I was saying earlier, these accounts, so our purchases, purchase returns and allowances, and your freight in, these would all be GL accounts. So although we're not going through recording the entries under periodic, in that system, they would be recording those transactions and they go into these accounts. So these would be the balances in each of these accounts at the end of the year, and therefore we can use that in this calculation. Okay, so this next part looks at the financial statements or the income statement under periodic. And we're not going to go in much detail because it breaks it out in the same manner as we looked at in the multi-step previously. But now, because we have this calculation for cost of goods sold, that full information is shown on the income statement. When we looked at the perpetual method, we always were recording that cost of goods sold. So we just had one line that showed our cost of goods sold, which was in that account. Under periodic, you actually have to show this breakout and calculate your cost of goods sold on the statement. Okay, so that is really what you need to know for periodic, just how to calculate that the cost of goods sold amount once you've done the count. So below the video here, I've shown a practice question, so you can go ahead and practice that, and I will have a solution video for that.